In the previous example, I assume that it is a case where the holding company sold the asset to the subsidiary company. We term this a downstream transaction. For a downstream transaction, the holding company will recognize the sale of fixed asset, which we would have eliminated in the consolidation process. For an upstream transaction, it is a case where the subsidiary company sells something to the holding company, and the subsidiary company is the one recognizing the sale. Now, how is this different? When the subsidiary company earns a profit, most of it is attributable to the holding company, but a minority of it goes to the non-controlling interest. This means, when we eliminate the sale, the subsidiary's profit will decrease, and the share of profit attributable to non-controlling interest will decrease. We need to make adjustments to the non-controlling interest accordingly. Let's now assume the holding company owns 75% of shares in the subsidiary company. In year 1, the subsidiary company purchased a non-current asset for $200,000. The useful life of the non-current asset is 5 years. At the start of year 3, the subsidiary company sold the non-current asset to its holding company for $135,000. The holding company continued depreciating the asset over the remaining useful life, that is, 3 years, since the subsidiary company has used the asset for the last 2 years. The first consolidation journal entry is to undo the gain or loss on sale recognized and revert the cost of non-current asset back to the original amount recognized by the subsidiary. At the start of year 3, the subsidiary will have an accumulated depreciation balance of $80,000 since it has used the non-current asset for 2 years. The gain on sale of non-current asset is the difference between the selling price of $135,000 and the net book value. We also noted that the holding company will record the cost of non-current asset at $135,000, which is a decrease of $65,000 from the original cost. Therefore, the consolidation journal entry to undo the gain on sale is debit sale of non-current asset $15,000. To revert the cost, we will debit non-current asset by $65,000. Then we will credit accumulated depreciation by $80,000 so that the debit equals credit. Next, we will revert the depreciation expense and accumulated depreciation balance. The subsidiary company charges $40,000 depreciation expense every year. The holding company charges $45,000 depreciation expense every year, obtained by taking $135,000 divided by the remaining useful life of 3 years, given that the subsidiary company has used the asset for 2 years. The difference in depreciation charge is therefore $5,000. To revert the depreciation expense and accumulated depreciation figure, the consolidation journal entry is debit accumulated depreciation and credit depreciation expense by $5,000. Since this is an upstream transaction, subsidiary company selling to holding company, these two consolidation journal entries will affect the subsidiary's profit, which affects the share of profit attributable to non-controlling interest. Before we proceed with adjusting the non-controlling interest, we need to compute the amount of profit that was affected. Essentially, consider the net effect of consolidation journal entries that will affect net profit. Debit sale of non-current asset and credit depreciation expense are the entries that affect net profit, and the net effect of these entries on net profit is a decrease of $10,000. The holding company owns 75% of shares in the subsidiary, so the remaining 25% goes to the non-controlling interest. The decrease in profits attributable to non-controlling interest is 25% multiplied by $10,000, giving us $2,500. The consolidation journal entry to recognize the decrease in profits attributable to non-controlling interest is debit non-controlling interest, balance sheet, and credit non-controlling interest, income statement, by $2,500. Let's try the consolidation journal entry for year 4, the year after the sales occurred. First, we will undo the gain on sale and revert the cost. Debit retained earnings $15,000, debit non-current asset $65,000, and credit accumulated depreciation $80,000. The figures are the same as for year 3, just that we debit retained earnings instead of sale of non-current asset because the sale of non-current asset would have entered retained earnings at the end of year 3. Next, to revert the depreciation expense and accumulated depreciation, we debit accumulated depreciation by $10,000. Take 2 multiplied by $5,000 because this is the second year where the holding company is using the asset. Credit depreciation expense $5,000. This is standard, where we will always credit depreciation expense by the difference between the depreciation charged by the holding company and the subsidiary company. Credit retained earnings by the remaining amount so that the debits equal credits. Now, did you notice that some entries affect retained earnings and some affect profit? Since non-controlling interest has a share in the equity components, we also need to adjust for the retained earnings attributable to non-controlling interest if the subsidiary's retained earnings is affected by the consolidation journal entries. These are the two entries affecting the retained earnings account, and the net effect is a decrease of $10,000. So the decrease in retained earnings attributable to non-controlling interest is 25% of $10,000, $2,500. There is an increase in net profit by $5,000 as seen from the credit depreciation expense entry here. So the increase in profit attributable to non-controlling interest is 25% of $5,000, $1,250. The consolidation journal entry is therefore debit non-controlling interest income statement $1,250, debit non-controlling interest balance sheet $1,250, and credit retained earnings $2,500. I understand it is confusing as to whether you should enter a debit or credit entry for this consolidation journal entry, given that non-controlling interest is reductive in nature and an increase in non-controlling interest is a decrease in the financial statement numbers. A good way to remember this is to look at the entry that affect non-controlling interest. We will enter the opposite of it. For example, there is a net decrease in retained earnings, so we will increase it by crediting it. There is a net increase in profit, so we will decrease profit by debiting non-controlling interest income statement.